Hey everybody, thanks for joining us. I'm Tara Hagen and this is Lynn Carbo. We're both directors at GTN and we're here to talk about risk assessment and your equity compliance. Just to kick it off this year, we are recording this in the beginning of the year and it's a good time to self-reflect and evaluate the past year, look ahead. Any New Year's resolutions, Lynn?
Tara, yes, as we're rolling to the end of January, I started with 2 New Year month of January commitments, one with Yoga with Adrian and a daily ultimate wellness with some motivational messaging on a daily basis. So that was great.
Awesome. I am also doing the daily yoga, so we have that in common. Lynn, I think, GTN, we didn't say, but GTN is a global tax firm that focuses on mobility and employees who live and work abroad and the compliances around that for employers and employees. We're a boutique firm and really are able to help our clients with those issues and risks. And I think Lynn's got a good story that helps lift this discussion off.
Definitely. So we were just speaking about a client, XYZ, who had an employee, Francie Finance, who a little over a year ago was planning for a relocation and holding restricted stock units. So she, as an informed employee within the finance side, recognized some of the issues that come along with what we're going to speak about today. So quite an interesting seat for this person to be in as a person serving the company in the finance side and someone who was going to be relocating and appreciating the nuances that come along with the equity reporting once she does relocate.
And I think that's a good story about why we're here today.
Most definitely. So our story with Francie raised several points that are worth sharing. So, we work with companies that have a lot of questions and try to get an understanding for why equity risk is an important item that should be addressed and reviewed for possible actions. And the nature of long-term incentives span multiple years. And companies will see many challenges when the employees have made a move in their work location or residence from the time that the grant was made to when the awards vest or are exercised. We could definitely talk for quite some time on all the topics that we've got listed on this page, but I think Tara has an interesting case with some similar fact patterns that you had experienced.
Yeah, I think Franny's case definitely speaks to a number of these bullets. And my case, I think hits all of them. So Franny definitely hits the not complying with tax and payroll and encountering some talent management issues since Francie was concerned about it. My case was somebody who moved to India from the US as opening up an India firm. They were similarly not compliant like Francie. And in that case, they incurred penalties and interest. So that added the incurring costs, budgetary surprises due to that non-compliance on the employer part and the employee part, and potentially risk for operations in India, bringing up those reputational concerns and duty of care for both the employer and the employee. In terms of our risk assessment that we're sharing with everyone, an online self-assessment, this really came to us from one of our clients who was really concerned about their what their level of risk was and if they could tolerate something higher. They were fully compliant, reporting in all relevant jurisdictions in the US and outside the US for domestic and international moves, but wanted to see if they could tolerate a higher risk than they currently were. They were very low. So in their case, they had a heavy lift, manual lift, and a heavy burden on resources. And that's kind of how our risk self-assessment started. And in that case, we did a bigger risk assessment for them in evaluating sort of the return on investment. But I think another great point of reference, in addition to that story of our origin story, is our recent survey.
Oh, most definitely, Tara. This was quite interesting. So GTN will shortly be releasing a Future of Mobility survey. And within that survey, a lot of questions were asked of organizations as to how these past years have made them take different approaches and review of what their organization and where their employees are. And along with this employee movement, the questions of what your compliance risks are associated with a mobile population. And what really struck me was when this question was asked and the responses had come back as summarized, 23% said they did not know what their highest compliance risk was in this realm. So today we like to take the opportunity to get the message out so that people are informed.
Yeah, and I think there's a lot of factors to look at. I think that's part of what's difficult. And we've outlined, I think, the sort of main ones that we really look at in our risk reviews that we do for a company, and in the self-assessment that we are offering online to look at sort of the main factors. And different companies value these factors differently. Some may be more important than others, depending on your volume, your location. And over the next few minutes, we'll look at those ones in blue that we put in our self-assessment. So the first one that we talk about is the stock price. And I know in the past year, when we recorded this session, the stock market has fluctuated quite a bit. And you know, when the stock is strong, companies have a different view and when it's dropping, or maybe it never significantly increased from IPO. I have a client we'll call Chocolate Bar Company, a company that we worked with, who really wanted a detailed risk assessment. They were similar to the case Lynn talked about, had full compliance, but were contemplating a different level of compliance based on their declining fair market value and see if they could tolerate a higher risk. But I think, Lynn, we should talk about our next factor.
Most definitely. Another factor that we like to have organizations review is the types of awards that they offer, as the type of award can correlate to the complexity as to how to become compliant or improve your compliance. So the issuance of stock options, non-qualified, incentive stock options, restricted stock units, and ESPPs, those types of awards create a year-round busy season for the individuals that are responsible within the equity and payroll space.
Year-round busy season definitely increases your risk. I had a case of a different kind of award, a restricted stock award, and we'll call that client Kangaroo Company, because they were based in Australia, where an RSA or restricted stock award can be more common, but it's less common in other locations, and in some places can be taxed at grant instead of at vest, adding some risk to your profile. So moving on to share volumes, again, kind of an obvious factor that, you know, the more awards, the more risk, but I think there's some nuances, and Lynn, I'd love for you to share that.
For sure. So share volumes we're looking at, is your award a broad-based type of award, such as a restricted stock unit? Often tech companies offer these across the board to all employees. And in many cases, they'll offer awards at varying times during the year and may oftentimes have frequent vesting schedules, such as quarterly. And that in and of itself creates tremendous volume and frequency in terms of demands on an organization's resources. But in addition to being a broad-based plan with volume by virtue of the number of employees, there can be high risks associated with a smaller population if perhaps a high volume is attributable with awards that are granted to senior employees, such as stock options or incentive stock options.
Speaking of executives and rank and file, I think the employee satisfaction factor, which is our next one, is another big one to consider. And I'd love Lynn, maybe talk a little bit about that one.
Most definitely. I think that this is quite important for companies to have a good handle on. As we had experienced with a client, the XYZ company with Francie, the topic of being compliant with the reporting and withholding had been going on for a number of years. And it wasn't until Francie was assigned to go to another location and her appreciation for wanting to appreciate and maintain the value of the award and appreciate what was going to be happening with the reporting and withholding in the multiple jurisdictions. So you want your employees happy, and when you have an employee who sits as a stakeholder too, I think that creates a great entree and an advantage point to other stakeholders as to what these nuances are.
Yeah, you want these awards to be a benefit, and if they're not happy or they don't understand, that won't happen. So I think another big factor, and I think the one a lot of people think of first, is the locations that they're awarding and where they are. And we'll start with the US domestic locations. We could go on and on with 50 states plus DC, and a majority of those applying an income tax and a trailing tax to those who leave. But maybe we'll highlight a few high-risk locations.
Most definitely. I sit in Pennsylvania outside of Philadelphia. So as people are probably aware, in Pennsylvania, we have a different treatment with respect to incentive stock options and ESPP qualified that Pennsylvania does not recognize, as well as having multiple localities that require reporting and withholding for compensation. And then Tara, you sit on the other coast in California, where there is no income tax treaty, and California has one of the highest tax rates in the US, so that's always a challenge. California wants to continue to see their revenue, and people may be moving out of California. And then New York, we can't really say, mention risks without mentioning New York State. New York non-residents have an obligation, and companies have an obligation to report and withhold as an employer. And then, of course, Francie, if she was coming out of New York, she would have had to do an allocation calculation on her tax return to identify and report that appropriate New York source amount.
I think the domestic locations are more and more on the radar, but let's look at non-US global locations, which I think have always been on the radar, well, at least especially for us at GTN. And again, are you in 2 countries or 25? It's sort of similar to that volume story, or somewhere in between. Or are you in a particular location that is high risk, and that may up your risk profile? And we can highlight a few locations we see as high risk.
Most definitely, we see the United Kingdom, the UK, as a high risk. They have a requirement for managing and reporting short-term business visitors that go into the UK for varying durations within a UK tax year. So their revenue, HMRC, has insights into people who are going into the country, and perhaps if they're high profile, seeing perhaps an opportunity for a source of revenue for people that have been in the UK and perhaps don't qualify as the visitor. In the Asia Pac region, Singapore is always a challenge, as individuals who are non-Singapore nationals, if they depart the country any unvested awards draw taxation at the time of the departure. And up north in Canada, with their national and provincial tax rates, their withholdings can be a combined 55% or more. And if there are still obligations within another jurisdiction for withholdings, there may be relief in the form of a waiver application to Revenue Canada. But those applications have been taking quite some time to be approved. So oftentimes that's been a challenge, and double withholding may apply and create some challenges for the company and the employees.
I think we could go on and on with 195 or more countries around the world, and again, a majority applying an income tax and a trailing tax to those who leave. But let's go to our last factor, the internal capabilities and how to get this all done.
Yes, it is a lot. And so wherever you might sit within an organization, can have a vantage point for how you view your risks to be within your organization, and appreciate that there are a lot of nuances involved with operating your equity comp plan, and how to be apprised and keep up to date with what the rules are for reporting and withholding in the domestic and global locations. So in Francie's case with XYZ, she had an appreciation. So she was able to get stakeholders to the table and address the concerns that she had, both as a stakeholder as well as an employee. So she was seeking some support, external support, in order to help her organization support her as an employee.
So we've gone through the self-assessment risk factors. Let's see the results.
Yeah, so this was interesting, Tara. So, we talked about at the start our resolutions for the year as we start 2023, wrapping up our first month. So it's interesting that we'll look to say we want organizations to make certain they do a check-in as we do for our own wellness. I think we want to do that on a corporate and professional basis as well.
Yeah, I think it's good news that you're low risk, but we know things can change, tax rules can change, where your populations are, where your volumes are. So at least an annual check-in makes sense, and we can offer that if that's helpful. Moving on to medium risk, a little bit higher, so maybe there's some more opportunities to lower your risk, and this self-assessment helps identify those. We can also help sort of narrow down what's your first step, and do a little bit of a risk review going beyond the self-assessment factors. And finally, high risk. It seems like there's probably some low-hanging fruit and definitely some things to address and things to lower your risk and look for your employers and for your company and your employee. But if you're not sure where to start, we can definitely help with a risk assessment and help you navigate that. We talked about the factors in that self-assessment, and there were 7, but there's several more that we do incorporate into a risk review or a broader assessment that we do. And we'd like to highlight of the ones in navy on the screen, two of them here today. And I'll talk about the costs and opportunities to reduce or automate, as I think that's one that comes up again and again when we're talking to companies who have to be reporting around the world for their mobile employees, and they want to know how to reduce the manual effort and the costs. And I'd be remiss if I didn't mention GTN's allocate tool that often is used to help do that. Lynn, maybe you can talk about benchmarking.
Yes, I think benchmarking popped up as something that's very important for organizations to have a good sense of. And as we had said, the upcoming release of GTN's Future of Work survey will provide some further insights. Everybody likes to see what other organizations within an industry might be doing, what are some best practices. So we like to see share the outcomes, and then you'll be informed. So the next time you take a survey asking what your risk might be, you won't say you don't know.
I think it's always helpful, and it's definitely something as a consultant we bring to the table, is that comparison. So it's very easy. You can go online or you can scan this page or go to this link. It's a quick self-assessment, gets you started, maybe something to use internally to raise the issue with your internal team, or just get your head around the idea for your own evaluation. And we're here for you as well to help navigate. So thank you, everyone,
Thanks for
joining
joining us.